It was once called the most innovative company in America, a Wall Street darling that promised to reshape the energy industry forever. Enron sold itself as a future, a company of visionaries turning electricity and gas into digital commodities, making markets more efficient, transparent, and free. But behind the headlines and billion-dollar smiles, something else was happening. A story of greed, deception, and manipulation on a scale the world had never seen. It wasn't just a corporate failure. It was a moral one, a warning about ambition unrestrained and success built on illusion. The story of Enron begins in 1985, with a merger between Houston Natural Gas and InterNorth, two modest regional pipeline companies. At the center of it was Kenneth Lay, a calm, polished executive with deep political connections and an unshakable belief in the power of free markets. Lay wasn't just a businessman. He was a true believer in deregulation, the idea that less government control would unleash innovation and competition in the energy industry. To him, the merger wasn't just a business move. It was the start of a revolution. Lay envisioned transforming a slow, traditional gas pipeline business into something bold and modern, a global energy trading powerhouse, a company that didn't just move natural gas it bought, sold, and traded energy itself like a financial asset. It was a radical idea for its time. Most of the energy world still operated on decades-old rules and regional contracts. But Lay saw an opportunity to turn energy into a market-driven commodity, and in doing so, to build a company that could dominate the future. That company would soon be called Enron. Enter Jefe Stories, a brilliant and ambitious consultant from McKinsey and company a man who thought more like a Wall Street banker than an energy executive. When Kenneth Lay met Stories, he found someone who could turn his dream of deregulation into something tangible and profitable. Stories proposed a radical idea that would change everything. Think of Enron as a gas bank. Instead of simply transporting natural gas through pipelines, Enron could buy and sell energy contracts, trading them just like stocks or commodities. Enron wouldn't just move energy, it would control the market for it. Lay was intrigued. The idea merged economics, technology, and finance into a single bold vision. If it worked, Enron could become a hub of a new, deregulated energy world, a place where prices were set not by regulators, but by traders. When Stories joined Enron, his confidence was infectious. He was sharp, persuasive, and fearless, the kind of leader who inspired both admiration and intimidation. Inside the company, people gravitated toward him. His charisma made them believe Enron could do anything. Under his influence, Enron began its transformation from a pipeline company to a high-stakes energy trading empire, powered not by fuel, but by ambition. Then came Andrew Fastow, a young, ambitious finance executive who would become the final piece of Enron's powerful trio. Fastow joined Enron in the early 1990s, quickly rising through the ranks with a reputation for creativity in finance, the kind of creativity that made impossible numbers look impressive. To Enron's leadership, that wasn't a red flag. It was a skill. His job was simple in theory but dangerous in practice, to make Enron's books look better than reality. When profits dipped, Fastow found ways to move debt off the balance sheet. When Wall Street demanded growth, he engineered structures that made losses disappear. Kenneth Lay had the vision. Jefe Stories had the strategy. And now, with Fastow, they had the financial magician who could make it all look real. As Stories climbed to the role of president of Enron, the partnership between the three men cemented. They became the dream team, bold, intelligent, and utterly convinced they were building something historic. Together, they weren't just running a company. They were rewriting the rules of corporate America, or so they believed. By the mid-1990s, Enron's stock was soaring. Investors couldn't get enough. The company was being hailed as a crown jewel of the new energy economy, sleek, innovative, unstoppable. Inside Enron, employees were encouraged to buy company stock, pouring their life savings and retirement funds into the dream. Every quarterly report brought new headlines, new praise, and new wealth. Kenneth Lay was celebrated as a visionary CEO, the man who had turned a pipeline company into a global powerhouse. Enron seemed to embody everything America admired: ambition, innovation, and success. But behind the curtain, the pressure was suffocating. Wall Street's expectations grew higher every quarter, and Enron's leadership became obsessed with one thing: meeting the numbers, no matter what. Jefe Skilling's aggressive culture demanded constant growth. Even when reality couldn't keep up, the traders pushed harder. The accountants got more creative, and Fastow's financial magic became the only thing keeping the illusion alive. The problem with being a genius on Wall Street is you have to prove it every 3 months. Then came Jefe Skilling's masterstroke, a new accounting method that would change everything: mark-to-market. Under this system, Enron could record the full projected profit of a deal the moment it was signed, even if that money wouldn't actually be earned for years or might never be earned at all. It turned long-term contracts into instant revenue. On paper, Enron looked unstoppable. In reality, the company's profits were built on assumptions, estimates, and imagination. To Wall Street, Enron was breaking barriers. To insiders, it was blurring the line between innovation and illusion. It was legal. It was brilliant. And it opened the door to deception. As Enron's profits began to wobble under the weight of its own ambition, Andrew Fastow stepped in with a darker kind of creativity. He built a web of off-balance sheet entities, shell companies with harmless names like LGM1 and LGM2. On paper, they looked like independent investment partnerships. In reality, they were designed to hide Enron's massive debts and inflate its earnings. Every time Enron's real numbers fell short, Fastow would shuffle money through these shadow entities, creating the illusion of stability. The balance sheet sparkled, the stock kept climbing, and Wall Street never questioned a thing. Enron became a cultural phenomenon. Its executives graced magazine covers, hailed as the architects of a new economy. Investors lined up to pour in cash. Employees strutted to the glass towers of Houston like rock stars, rewarded with huge bonuses for short-term profits, even if those profits were built on lies. Inside the company, a new identity took hold: Enron culture. It celebrated arrogance, rewarded risk, and worshiped success at any cost. At Enron, greed wasn't flaw. It was rebranded as innovation. As Enron's empire expanded, so did its mystique. Analysts, reporters, and investors were dazzled by its complexity. Sprawling divisions, high-tech trading floors, and a new language of finance that few outside the company could understand. Enron stock soared to nearly $90 a share, making it one of Wall Street's crown jewels. Year after year, Fortune magazine named it the most innovative company in America. 6 years in a row. But behind the headlines, there was a dangerous truth. No one really knew how Enron made its money. The financial statements were a maze of jargon and numbers that didn't add up. Every time a journalist or analyst pressed for clarity, they were met with charm, confidence, or intimidation. And that's exactly how Jefe Skilling wanted it. He once told a reporter, "You just don't get it." Enron's opacity became its armor. The more confusing it was, the smarter it seemed, and the more untouchable it became. In a world that worships innovation, mystery can be more powerful than truth. Inside Enron's glittering headquarters, Jefe Skilling pushed his obsession with performance to a brutal extreme. He introduced a policy known as rank and yank. Every year, employees were graded on a forced ranking system, and the bottom 15% were fired, no matter how hard they'd worked. The result was a culture fueled by fear, ego, and ruthless ambition. Colleagues became rivals, loyalty vanished, and the only goal was to stay on top by any means necessary. Meanwhile, Enron's appetite for growth became insatiable. The company began expanding far beyond energy. Broadband trading, promising to revolutionize the internet. Water markets, trying to control global supply chains. Even weather derivatives, betting on temperature fluctuations like gamblers on Wall Street. Each new venture was pitched as the next big breakthrough. But behind the scenes, profits were dwindling and the numbers no longer made sense. At Enron, innovation had stopped being about ideas. It had become a disguise for desperation. Amid the chaos of Enron's soaring ambitions, a few insiders began to see the cracks forming. Internal auditors and analysts quietly questioned the numbers, the missing cash flows, the impossible profits, the partnerships that seemed to vanish when examined too closely. Most were ignored or silenced. But one voice refused to stay quiet. Sharon Watkins, Enron's vice president of accounting, started digging into the books. What she found terrified her: layers of deception, hidden debt, and accounting tricks so elaborate they could only lead to collapse. She warned senior executives, writing a now-famous memo that called Enron a house of cards ready to fall. Her message wasn't welcomed. Within Enron's walls, truth had become a threat. When you build a company on illusion, truth becomes your greatest enemy. As the dot-com bubble burst in the early 2000s, the tide that had lifted Enron's illusion began to recede. Market conditions shifted. Energy prices dropped, investor confidence wavered, and suddenly, the endless stream of profit Enron had promised began to dry up. Inside the company, panic grew. The shell entities that once had billions in debt were now collapsing under their own weight. Fastow's financial engineering could no longer mask the losses. Analysts started asking tougher questions, and for the first time, Enron had no answers. The empire that once seemed invincible was beginning to crack, and this time, no amount of creative accounting could save it. When the market turned, Enron's brilliance vanished, and all that remained was the truth. By mid-2001, the pressure inside Enron had reached a breaking point, and Jeffrey Skilling, the architect of the illusion, began to crack. At a press conference, an analyst dared ask a question that had lingered for years. "Can you explain how Enron actually makes money?" Skilling, usually smooth and confident, snapped. His mask slipped. He leaned into the microphone and muttered a single infamous word: "Asshole." The room fell silent. For the first time, the world saw something Enron had spent years hiding: insecurity behind arrogance, chaos behind confidence. Over the next few months, Skilling grew increasingly erratic and withdrawn. Then, without warning, he resigned, citing personal reasons. Investors were stunned. Employees whispered. And Kenneth Lay, the man who had started it all, quietly stepped back in to take control. The genius of Enron had left the building, and with him, the illusion of control. In the weeks after Skilling's abrupt departure, Sharon Watkins knew something was deeply wrong. The numbers didn't add up, the off-balance sheet entities were imploding, and the walls were closing in. So she did what no one else dared to do. She put her concerns in writing. Watkins sent a confidential memo directly to Kenneth Lay, warning him that Enron was on the brink of disaster. "I am incredibly nervous that we will implode in a wave of accounting scandals," she wrote. It was a desperate attempt to save the company, or at least to tell the truth before it was too late. But Lay's response was pure denial. He told employees to stay calm, assuring them Enron was strong, that the rumors were false, and the company would bounce back. Behind the scenes, however, the truth was spreading, and the countdown to collapse had already begun. When the truth knocks, the powerful rarely answer until the walls come crashing down. As Watkins' warning quietly circulated within Enron, word began to leak beyond its walls. Whispers reached journalists, analysts, and eventually federal regulators. Reporters started connecting the dots. Strange financial disclosures, missing assets, and mysterious partnerships linked to Enron's own CFO, Andrew Fastow. What they uncovered was explosive. Fastow had personally profited from the very shell companies he created to hide Enron's debt. The illusion of independence crumbled. It was Enron paying Enron, a house of mirrors collapsing on itself. Soon, the SEC launched an investigation. Fastow was forced to step down, and investors began to panic. The market that once worshipped Enron's complexity now saw it for what it truly was, a masterpiece of deceit. The moment the truth began to leak, Enron's brilliance dissolved and its lies flooded the streets. October 2001. After months of denial and rumors, Enron could no longer hide the truth. In a stunning announcement, the company revealed it would restate its earnings, admitting it had overstated profits, by nearly $600 million over the previous years. What had once been hailed as the most innovative firm in America was now exposed as a corporate mirage. Andrew Fastow was fired. The SEC launched a formal investigation, and within days, confidence in Enron, once untouchable, collapsed overnight. Stockholders panicked. Employees watched their life savings vanish, and the media that once praised Enron turned on it with fury. The proud glass towers in Houston, once symbols of limitless ambition, now stood as monuments of deception. For years, Enron sold the world a dream of endless growth. In the end, all it delivered was a bill. December 2nd, 2001. The inevitable finally arrived. Enron, once the seventh largest company in the United States, filed for bankruptcy, marking the largest corporate collapse in American history at that time. Within weeks, more than 20,000 employees lost their jobs. Pensions and retirement funds, heavily invested in Enron stock, were wiped out overnight. Families who had believed in the company's promise were left with nothing. Investors who once praised Enron's vision now faced financial ruin. The skyscraper that once bore the Enron name in downtown Houston became a symbol of betrayal and greed. In less than a month, the world's most innovative company became its most infamous. The numbers told one story, but the human cost told another. In the aftermath of Enron's collapse, cameras capture employees leaving the building with cardboard boxes, faces blank with disbelief. The laughter and confidence that once filled the halls were replaced by silence and anger. Retirees who had spent decades with the company watched their life savings vanish, their pensions tied up in Enron stock that was now worthless. Some lost homes. Others lost hope. Former employees spoke through tears and interviews, struggling to understand how a company they trusted could betray them so completely. Empty offices, abandoned desks, flickering computer screens, symbols of broken faith and corporate greed. They built their lives on Enron's promise. And when the illusion collapsed, so did their futures. In the years that followed, the wreckage of Enron moved from Wall Street to the courtroom. Jefe Stories and Kenneth Lay, once hailed as visionaries, now stood before federal judges, charged with fraud and conspiracy. The same men who had been celebrated on magazine covers were now symbols of corporate corruption. Andrew Fastow, the financial engineer who built Enron's deceptive empire, pleaded guilty and agreed to cooperate with prosecutors. His testimony laid bare the culture of greed and deceit that had driven the company's rise and fall. The trials gripped the nation. Witnesses described intimidation, manipulation, and lies dressed up as innovation. Before sentencing, Kenneth Lay suffered a fatal heart attack, escaping prison but not infamy. Jefe Stories was found guilty on multiple counts and sentenced to 24 years in federal prison, one of the harshest penalties ever for a corporate executive. The men who built Enron's empire of lies finally faced judgment not in the boardroom, but in a courtroom. In the wake of Enron's collapse, Washington and Wall Street were forced to confront a painful truth. Unchecked ambition and blind trust had broken the system. The scandal led directly to the Sarbanes-Oxley Act of 2002, sweeping new legislation designed to hold executives accountable, protect whistleblowers, and bring transparency to corporate accounting. For the first time in decades, the financial world began to rethink the meaning of innovation. The very word that once symbolized progress now carried a warning that brilliance without integrity can destroy everything it builds. Enron promised to change the world. And in the end, it did, just not the way it intended. Enron wasn't just a company. It was a reflection of our own greed. A story of ambition without ethics, of brilliance without boundaries. In the end, the world didn't destroy Enron. Enron destroyed itself.